Jernad Trust here. In this video, I'm going to break down various approaches when it comes to investing in stocks. So you will just pick which one works best for you. Okay, so let's get into it. The first strategy we have is the buy and hold strategy, right? Now, with this strategy, you want to keep in mind ROE, that's return on equity, right? Which basically measures how efficiently a company generates profits from shareholders' equity. So the higher the ROE indicates a company is effective at turning investment into profit, which is why we want to consider that, right? It's the buy and hold. We're holding for a bigger investment. The next thing to consider with this strategy is the EPS. That's the earnings per share. So that indicates profitability on a per share basis, right? A steadily growing EPS suggests consistent profit growth, okay? We have price to earnings, that's the PE ratio, which compares share price to earnings per share, which is basically a reasonable or low PE relatively to the industry or historical averages. Can signal value, which is basically a very high PE may indicate overvaluation. Okay, another thing to consider when using the buy and hold strategy is the dividend yield, which shows how much cash flow you're getting for each dollar invested through dividends. So, it's very important for income-focused investors and a sign of financial health if stable or growing. Okay, you also want some free cash flow when it comes to the buy and hold strategy. Cash remaining after operating expenses and capital expenditures, right? Positive and growing FCF indicates the company can fund growth, pay dividends, or buy back shares without taking on excessive debt. Okay. Also take into account the debt to equity ratio, which measures financial leverage and risk. Lower ratios generally indicate less risk, but context by industry is very important. And then you also want to look at the revenue and the cash flow growth. So consistent growth in revenue and cash flow is a strong indicator, of a company's long-term prospects. Be wary of volatility, right? So basically that's the beta. The beta measures a stock's sensitivity to market movements. So lower beta stocks are less volatile and may be preferable for long-term risk-averse investors. Remember, buy and hold, right? We have the Shape ratio. So which assesses the risk adjustment, returns. A higher, Sharpe ratio means better returns for the level of risk taken. Then management and quality of, basically the competitive advantage. It's not really always quantifiable, right? But strong shareholder friendly management and a durable competitive advantage, right? That's the economic moat, are critical for a long-term success in regards to the buy and hold strategy. Now, some stocks to look into that may make sense for this approach is the Microsoft stock, which continues to deliver robust free cash flow and is a leader in AI and cloud computing with a strong dividend track record. The next stock for the buy and hold strategy to look into is the Apple, right? Apple stock, which remains a dominant force in consumer electronics and services with a history of innovation and shareholder returns. You have NVIDIA, right, which is a key player in AI, data centers, and gaming, benefiting from, secular growth trends. Alphabet, which is the parent of Google, basically has strong positions in digital advertising, cloud, and AI. Amazon, which is e-commerce and a cloud computing giant, consistently ranked among top analyst picks, right? Broadcom, the semiconductor and software powerhouse with strong revenue growth and exposure to AI infrastructure. You have the Taiwan Semiconductor Manufacturing Company, which is the world's largest chip foundry, critical to global tech supply chain. Now, one of the things to look into with this strategy, especially the stocks offered, is AI. So look into some AI stocks for this strategy. The next strategy we have is index funds. Okay, the first strategy was buy and hold. The second strategy I'm about to get into right now is index fund. Now, you have the expense ratio to look at. That's the percentage of fund assets paid for management and administrative expenses. And here's why it matters. The lower expense ratios are preferred as high fees can significantly erode long-term returns, especially in passive index funds where, costs should be minimal. Also look into tracking error. which is the difference between the fund's returns and the returns of the indexed, it aims to replicate. And why? Because a low tracking error indicates the fund closely mirrors, its benchmark, which its primary goal of an index fund. Look into the historical returns. So the fund's performance, basically over various time frames, whether it's 1, 3, 5, 10 years. Why? Because consistent long-term returns that closely match or slightly exceed the benchmark are a positive sign. So compare these returns to similar funds and the index itself. You have risk-adjusted returns for this strategy as well. That's the Sharpe ratio, right? And some of these, little bit of them may overlap, right? Because some approaches have similar characteristics. Now, the Sharpe ratio, that's the risk-adjusted returns, which measures how much return the fund generates for each unit of risk taken. Why this matters for this approach? A higher Sharpe ratio means better risk-adjusted performance, which is especially important for comparing funds with similar strategies, right? Keep in mind the fund size too. That's the total market value of assets managed by the fund. And it matters because the larger funds tend to have better liquidity and are less likely to be closed or merged, but extremely large size, can sometimes make it harder to track the index precisely. Be wary of the benchmark comparison. That's, basically how well the fund performs relative to the index it tracks. Now, why? Because the fund should closely match the performance of its benchmark over time. Persistent underperformance may indicate high cost, or poor management. There's the fund provider reputation. That's the track record and reliability of the company managing the fund. This matters because trustworthy providers are more likely to manage the fund efficiently and securely. Okay. Now, one of the good things about, this approach is the dividend yield, right? That's the income generated by the fund as a percentage of its price distributed to the investors like us. Now, this matters because it's relevant for investors seeking regular income in addition to capital appreciation. Okay. Next in this strategy is the portfolio composition and asset allocation. That's the breakdown of holdings within the fund. And it matters because it ensures the fund is sufficiently diversified and accurately reflects the intended index. Liquidity is important, right? That's how easily you can buy or sell the shares of the fund. And this matters for this approach because higher liquidity means you can enter or exit positions with minimal price impact. Now, some stocks to consider for this strategy is the S&P 500 index funds like the FXAIX or the VFIAX, the SWPPX, or the FNILX, right? That remains the backbone for most long-term investors, providing exposure to the largest and most stable U.S. companies. You can look into mid-cap or growth-focused index funds such as the VMCPX or the FSPGX that can add diversification and capture higher growth potential, especially as sectors like AI, cloud computing, and biotech drive market gains as of 2025. We have the NASDAQ 100 index funds. That's the NASDX, the QQQ. Basically are ideal for investors seeking additional exposure to technology and innovation leaders. Okay, so that was that strategy. We went over 2 strategies thus far. The third strategy is the dollar cost averaging. Okay, so that's where you choose high volatility assets. The DCA is most effective with assets that experience significant price fluctuation. So volatility increases the likelihood of buying more shares at lower prices, thus lowering your average cost per share. So you have to maintain strict investment discipline for this strategy, right? Basically invest in a fixed dollar amount at regular intervals, whether it's weekly or monthly, regardless of market conditions. This removes emotional decision making and market timing errors, ensuring consistent accumulation of the shares. Okay, then you have to optimize the interval and amount. So while monthly intervals are common, more frequent investments like weekly can further smooth out price volatility, especially in highly liquid markets, right? However, you have to be mindful of the transaction fees, which can erode returns if investing too frequently with small amounts. So there's a rule called the enhanced DCA with, rule-based adjustments, right? That, research basically suggests that enhanced dollar cost averaging can outperform traditional DCA. EDCA is a rule-based strategy that adjusts the amount invested based on recent prices, the movements or volatility. So as an example, you can increase your investment amount after significant price declines. You can reduce or pause investments after sharp price increases. Simulations show EDCA can improve returns by 30 to 70 basis points per year compared to the standard DCA, especially in volatile or bear markets, right? You can automate the process. You can use automated investment platforms, right? Or brokerage features to ensure that, there's a regular unemotional execution of your DCA plan. So automation prevents missed contributions and maintains discipline. Okay, then you have to reinvest the dividends. So if your chosen stocks or ETFs pay dividends, opt to automatically reinvest them. This compounds your returns and increases the number of shares accumulated over time. Then you have to monitor and periodically review, right? So while the DCA is basically kind of like a set it and forget it strategy, periodically review your asset allocation and investment goals. You have to adjust your DCA plan if your financial situation or market conditions change significantly and combine with the buy and hold. So DCA works best with, when it's paired with a long-term buy and hold approach, right? That's the first strategy we talked about. So selling too soon can negate the benefits of the strategy, especially during temporary downturns. Now, here are some stocks to consider for this approach. You have Ulta Beauty, Sprouts Farmers Market, Southwest Airlines, PayPal, Alibaba, and Nike. Basically these companies are highlighted for their strong fundamentals and potential for long-term outperformance, especially when, bought consistently over time. You have Whirlpool, which offers value and a high dividend yield, appealing for, basically for income-focused investors, right? So that was that strategy. The next strategy we have is the Robo-Advisors, right? Robo-Advisor strategy. That's where you leverage advanced customization and accurate risk profiling, right? So to ensure your risk tolerance, investment goals, and time horizon are accurately captured during onboarding, the more precise your input, the better the Robo-Advisor can tailor its portfolio recommendations to fit your specific needs. You have to choose platforms that offer high levels of customization to align portfolio allocations closely with your unique risk profile rather than just relying on generic models, right? You have to emphasize diversification and asset allocation. Robo-advisors use algorithms, which is often based on modern portfolio theory or its variants, to build diversified portfolios that optimize the balance between risk and return. So you have to take advantage of the Robo-Advisor's ability to analyze historical data, market trends, and economic indicators to allocate assets across various sectors, geographies, and asset classes, reducing concentration risk. Then you have to utilize automated rebalancing and monitoring. So Robo-Advisors continuously monitor portfolios and automatically rebalance holdings when allocations drift outside predefined bands, which is basically maintaining optimal risk/return characteristics without manual intervention. So basically this process is efficient and cost effective, especially since Robo-Advisors are designed to minimize transaction fees associated with frequent rebalancing. After that, you have to optimize for tax efficiency, right? So many Robo-Advisors implement tax loss harvesting strategies, automatically selling securities at a loss to offset capital gains and minimize tax liabilities. So you have to ensure your Robo-Advisor is programmed to avoid wash sale violations by selecting appropriate substitute securities during the harvesting process. You can benefit from AI and machine learning enhancements with Robo-Advisors, right? Advanced Robo-Advisors incorporate AI and machine learning to dynamically adapt strategies based on real-time, data, market movements, and user behavior, potentially identifying new investment opportunities and mitigating risks more effectively than static models. These systems can adjust asset allocations or recommend tactical shifts in response to changing market conditions. However, you have to avoid overtrading with excessive fees when using Robo-Advisors. While using robo-advisors, automated trading, you have to avoid platforms or settings that encourage excessive trading, as this can erode returns through higher transaction costs. So focus on platforms that emphasize long-term passive investing rather than frequent active trading. You have to use educational tools and visualization to maximize this approach as well, because some robo-advisors offer visualizations of the efficient frontier and educational resources, helping you understand the risk/return trade-offs and the impact of portfolio adjustments. You have to engage with these tools to make more informed decisions and to better understand the algorithm's recommendations. Some robo-advisors to consider, right? You have the Vanguard Digital Advisor. That's the minimal investment. It's basically about $100. The fees is about 0.20% per year, including underlying funds. It features the Vanguard's life cycle investing model, customized portfolio of passive ETFs, automatic rebalancing, and glide paths based on your age and goals, right? Higher balances unlock access to human advisors and additional services, right? The next we have is Fidelity Go Minimal Investment, right? Is $0. You need $10 to start investing though, right? The fees is basically free for accounts under 25,000, right? 0.35% annually. Above that features, you can use 0 expense ratio Fidelity Flex funds, simple risk questionnaire, and access to Fidelity advisors for larger accounts. There's no tax loss harvesting in that platform. Now there's the Better Mint minimal investment is $0, but you need $10 to start investing. The fees are 0.25% annually, 0.65% for premium with CFP access, which features a mix of low-cost ETFs, automatic rebalancing, goal-based investing, and advanced tax optimization strategies. There's the premium tier that includes certified financial planners. Schwab Intelligent Portfolios is another one too. It's $0 for the minimal investment. There are, in regards to fees, there's no management fee for the basic service. There's $30 per month for premium with CFP access. It features automated, portfolios using 12 risk profiles like the tax loss harvesting and thoughtful rebalancing. However, note this: cash allocation can be high, which may impact returns. Okay, we have Wealthfront minimal investment is $500, a little bit more expensive. The fees are 0.25% annually, right? 0.25% annually. It features a goal-based investment, right? Tax loss harvesting, direct indexing, and wide ETF selection, and customizable portfolios, and also offers competitive cash management and ability to borrow against your account. We have the SoFi automated investing. The minimal investment is $1. The fees are $0. It features portfolio diversification, personalized advice, tax loss harvesting, and an easy to use interface, especially attractive for new investors, basically due to its low cost. The next the next tax strategy we have is income investing, right? So this is the last one for this video. It focuses on dividend growth stocks, prioritizes companies with long history of paying and consistently increasing dividends, such as those in the S&P 500, the dividend, aristocrats index. So these companies are generally stable, financially healthy, and less likely to cut dividends during downturns. You have to consider the dividend yield and sustainability, right? So look for a balance between a reasonable dividend yield and the sustainability of those payments. So extremely high yields can signal risk, right? Instead, target, companies with solid fundamentals and a track record of steady or growing payouts. Diversify across sectors and industries, right? So reduce the risk by holding dividend-paying stocks from various sectors, whether it's consumer staples, utilities, healthcare, etc., which can help sector if one sector underperforms. Then use dividend-focused ETFs or mutual funds. For simplicity and diversification, consider dividend ETFs or mutual funds which pool together many dividend-paying stocks. This approach can reduce the risk of individual stock selection and provide broad market exposure. Then monitor and rebalance regularly, right? Periodically review your portfolio to ensure it aligns with your income goals and your risk tolerance, right? So rebalance as necessary to maintain diversification and adapt to changing market conditions. That's what I have for you today. Please take a moment right now to hit that subscribe button and the like button. I see you on the next video.